we love property. This country is obsessed with property. But is there another way to play the space without, we know, prohibitive costs? Alex Lee joins us from Loyola Advisors to discuss. Alex, welcome to the program. Now, every arm of policy tells us to buy a house for retirement reasons, lifestyle reasons, but you think the glosses come off that as an asset class. So where are you coming from?
Thanks for having me. I think the gloss has come off. We have to look at real estate in a more holistic manner. I think our love affair with real estate started maybe 30 years ago. 30 years ago, property wasn't really considered as an investment. It's a place where we lived in, right? And from that point of view, we would have seen some of the non-correlation to the public markets that come from property, right? And we would have seen a property that would have cost, say, $250K back in the 90s rise up to about $2 million right now. Now that kind of headline figures looks fantastic, right? And would appeal to a lot of people, but that really translates to a 7% return, right, per annum.
Yes. And
one has to think about, are there any other things that we can invest in that would give about 7% in return, or better?
Okay, so what are the various options out there that you can go and look at, including the risk profile of what you're investing in? What are the potential opportunities?
Yeah. My fund, the Loyola Fund, invests in life settlements, and that's one of the opportunities that's out there. It's uncorrelated to the market, which is like real estate back in the 90s. It provides a return of 7 to 11% per annum, and it's not linked. It's not linked to the equity not linked to the equity market with very low volatility from month to month. So those are the kinds of, and there are other investments, like, for example, property debt that you might get into. There might be other private credit instruments that you could get into, and those could give you a profile of low volatility and a return in the same range with no correlation to equities, for example.
So in terms of, it's sort of a bit of an adage that, for example, Sydney house prices double every 10 years, despite some bumps along the way. You say your returns are closer to 7 and 11. Over what time frame is that exactly?
So real estate prices, the return from real estate prices was at 7%. That's a number that's published by the Australian Bureau of Statistics. That's a gross return over a 30-year period, and to double in price, you probably need about 7% per annum over 10 years to get a doubling. And so the numbers do line up, and that's correct.
But how long has your sorry Alex to interrupt, but how long has your fund been operating for? Because in an environment where we've got rock bottom interest rates, 7 to 11% is very high, so it implies there's a lot of risk attached. Is that necessarily the case?
No, the fund has been operating for about 7 years, almost 8 years now. So that's throughout post GFC all the way through to now. The risk taking in this fund is a risk associated with the policies that we invest in. We are essentially extending financing to individuals backed by the individual's policy. It's a form of financing, yeah. And the returns are generated when the benefits are paid out from the policies. So you can see from this kind of relationship, there is no linkage to interest rates or the equity markets. What we found, and this is a study that's conducted over the last, I think, 10 years, that regardless of what interest rates are, the returns on investing in life settlements is fairly consistent around the 7 to 11 range.
That sounds like a very interesting one and something that we'll be keeping an eye on. Thank you for bringing it to our attention, Alex Lee from Loyola Advisors.
Thanks for having me.